Hello, hello. Good afternoon. Miguel Castaneda here from Guerra Wealth Advisors. Um, this is going to be our market update for the month of September. So uh, hope you guys are tuning and I got a lot of information for today. So big news today, pretty big news today for those of you that follow the market, that follow the news. I'm pretty sure that you guys are aware that we got rate cuts today. So we're going to discuss that, and we're going to discuss a little bit of the outlook of the market. But let me start with giving you a little bit of who am I. So I joined Guerra Wealth Advisors back in 2008. Tough moment to start in this business, but it was a great moment for learning. We've been working over 17 years with the Guerra family and our team helping families reach their financial goals. And over the years, we've gone over several times in different workshops about different subjects, such as market updates and investment management, retirement income planning, and tax strategies, all these different subjects that we touch up. So just a little bit about me and what I've done here with Guerra. Um, I always like to start with letting people know that we work through Fidelity Investments. That's the custodian that we use. We've been with them for over several years. And just so that you know, when you work with a financial advisor, with a financial planner, they should be using a custodian that's well known, that is recognized, that you guys are not writing a check to the advisor firm, but instead you're giving it to Fidelity or Vanguard or whichever company it is, you know. I see that a lot of you guys have already tuned in. Yes, we've been excited to get here. And I know that if you guys have any questions, we're gonna have this chat, so you could write your comments or questions, type in there. I'm gonna be reading them. Some of you guys potentially have questions on what's happening with the market. Okay. What we do at Guerra, and I just go briefly about this before we get into the entire nitty-gritty of investments. We basically cover 5 areas for people that are interested in retirement planning, investment management, tax planning, asset protection, and estate planning. We cover these 5 areas when we do planning for our clients. Everyone works with the intention of getting to a point in their life where work is an option and is no longer an obligation. And that's what we call retirement. You work because you want to, but not because you have to. And in order to do that, obviously, you need some tools, some investment management tools to be able to accomplish that, get to that freedom number is what we call it, where you can actually say, hey, I don't need to work anymore. I can just sustain my lifestyle. And so we have to do projections and run numbers and do all that stuff. Taxes are a huge subject because a lot of the people that we talk to, a lot of the families that we talk to amass a ton of wealth in qualified retirement plans that are taxable, and therefore you got to create those tax strategies such as Roth conversions to be able to mitigate those taxes in the future. Definitely, once you build your wealth, you don't want to lose it, so you create that asset protection strategy and put things in place so that everything that you've grown so far stays within your family and the people that you love, right? And definitely estate planning. A lot of people don't pay attention to that. They think it's for millionaires, but truly estate planning is something that everyone should have. Everyone should have a estate plan to make sure that what you want to happen with your funds and with your wealth and your money and your family and your desires actually happens. Okay. So when we go about this process, people come and meet with us. We go and do an assessment of their situation, and literally like we do in school, we're going to go into this Guerra Freedom Plan process, and we do kind of like a scorecard, you know, where we give you grades on different areas, right? What's happening with the retirement income planning? Maybe you already have a maximization of your Social Security strategy. Maybe you don't. Maybe you already know what's the withdrawal order of your accounts so that you could be more effective in retirement, right? Maybe you don't. So depending on that, we're going to rate you on those areas, right? Maybe your investments are performing extremely well, or maybe they're not even performing as the benchmark is. Are you running too much risk? Should you run that much risk? What type of investment should be in your portfolio? All of that stuff gets assessed in this visit when you guys come see us. For those of you that are clients, and I know that there's a lot of clients listening to me today, if there's any of these areas that you need to touch up with one of our advisors, feel free to reach out. Feel free to put your comment or have somebody in the office contact you so that you guys can set up a meeting and review any of these areas, right? Tax reduction, very important. Something that's very has become very popular nowadays is the Roth conversions. A lot of people talking about Roth conversion. So maybe you don't have a strategy for Roth conversions. Maybe you got to see an advisor for that, right? Asset protection planning, make sure you protect yourself from long-term care situations. Make sure you protect yourself from lawsuits. Make sure you got the right insurance, on your corner to protect you from those things that could wipe away your wealth. We don't want that to happen, right? And then last but not least, the estate planning. Make sure you transition your wealth correctly. Make sure you take care of yourself and you protect yourself if you happen to run into a situation of incapacitation, you got all the right paperwork to go the right way, okay? But this is kind of like the process that we run through. I like to explain this before we get into the nitty-gritty and just, invite you guys, those of you that are not clients, if you want to reach out to our firm, make sure that you guys click the links and you guys can set up an appointment, talk to one of our advisors. I see that we have some comments in here. Jimmy is always on time and the company is growing. Yeah, Jimmy is amazing. He's always taking care of everything in this office and in all the clients that he services. That's awesome. Jimmy is one of our advisors. For those of you that don't know, we got about 10 advisors. So yeah, somebody just made a comment about Jimmy. I love Jimmy as well. Some people are also commenting on some of the events that we just had, and we're going to cover that in a second. But what are we going to talk about today? The market update today is about breaking down the market performance. What's happened so far with the stock market, where what's driving those moves, what are the key trends to watch, okay? Economic outlook and key indicators, what's happening with inflation, interest rates, and major factors that could shape the economy for the months ahead. So we're going to look into that. All right, opportunities and risk ahead, areas of potential growth, sectors to watch, and what factors that could impact your future performance on your portfolios. So that's important, okay? Before we get into it, a couple of months ago, part of the team actually was invited to the New York Stock Exchange. The other Miguel and myself and our founder, Mauro Guerra, were actually at the New York Stock Exchange with BlackRock and with advisors Excel Wealth Management, getting some training and picking up on some trends of what's happening in the market. So I just wanted to share that with our clients. I know our clients are watching us and they really like that. Really proud moment for us, for our firm to be there and to participate in events like this. But even a prouder event was the one that we went through over the last Saturday, which some of you guys attended. I see here that Maite was at the Miami Retirement Summit. So this was the biggest event, the biggest retirement event, according to what I know, in the nation. Okay. We got over 500, 600 people. We had great speakers, Jeff Bush. We got Sebastian Guerra, obviously. We had Maria Diaz from the Social Security. She worked there for about 30 years. She knows all the ins and outs. We also had Tom Siomatis, the CFA from Wealth Advisors, the CFA from Advisors Excel Wealth Management, and giving us a little bit of insight on what's happening with the market. We also had Coach Spoelstra, Eric Spoelstra from the Miami Heat, talking to us a little bit about mindset, a little bit about goals, a little bit about resilience, and all those things that we need in life to be successful, and how to make sure that we set those goals and drive towards them and make sure that we take care of all that stuff on the way. It was a great event. Thank you for those of you that actually went with us, and it was a long day, but stood there, learned a ton. And some of you guys might be seeing us soon, coming to the office and reviewing your plans and stuff like that. We do a lot of different events throughout the year, just like this one. and because we're very, very big on education about retirement and all that stuff. So thank you for those that actually made it happen. Thank you to the team that did an amazing job, and hope to see you in a future event like this as well. If you have never been to one, try to find a way to get to it. Okay. Now let's get into the business. Let's look at the stock market. What's happening in the stock market so far year to date? So year to date, I don't know if you guys recall, but for those of you that follow the market, I know that we weren't having so much fun back in April with the whole tariff conversation. Market had gone down about 15%, and all the indexes were coming down. Now, I ran this analysis just to show you guys where are we right now. The S&P has grown about 13%, 12.3% to be exact, so far for the year. We got the Dow Jones up about 7.5%, and the NASDAQ is driving the market with a 15% growth so far. Now, one interesting thing that I wanted to show you guys is the bond market is very steady, has been very steady this year, okay? It's grown about a 3.97, and that's why some of these, money market accounts and some of these accounts that are based on short-term treasuries are paying about that 3.5%, 4%. So this is what's happening so far. This is where we are so far in the year. I know that at the beginning of the year we were kind of like expecting an amazing year, and then we went into this downtrend because of the tariffs, and everyone was concerned about what's happening in the market. I hope you guys didn't sell all your investments in the middle of April and then didn't know when to get back into the market again. If you guys didn't know, that's where a financial advisor can actually assist you. Now, looking back 1 year ago to today, this is what these indicators look like. This is what these indexes look like. The S&P has grown about 17% so far in the last year. The Dow Jones is about almost 10%, and the NASDAQ has rallied 24%. Oh my God, what an amazing year has the technology sector had over this, from September of 2024 to September of 2025. It's been amazing. So those of you that were in the tech sector, communication sector, you probably have benefited tremendously. All right. Now let's take a look at the bond market. The iChart Core US Aggregate Index right here shows a negative performance over the last year. And yes, it is very steady. It's a very steady line in the graph, but it's still negative. And that has to do with the fact that interest rates have not come down, and they just started to come down today because we got some big news. So we're going to talk about what the impact of that is to the bond market and how is that going to be beneficial or is going to hurt them. But yes, those of you that might think that bonds are bulletproof or bond portfolios are bulletproof, they are not. They are definitely not bulletproof, especially with changing interest rates. You got to look out for those changes. Those drastic changes could throw down those bonds, and it could take years for it to come back, okay? So pay attention to that. Be on top of your portfolio. Make sure that you guys are reviewing this with your advisors, okay? We at Guerra do an amazing job at that. We got also about 70 plus team members in total that help us, that support us, that provide a lot of service to our clients. So feel free to reach out and call if you need to, okay? Sonia, thank you. Sonia, I'm reading your comment here. Congratulations to the office for the event. Thank you, Sonia. I appreciate it. I'm glad that you made it. Okay. And I see that Maite also took a ton of notes on the previous event. So that's great. We've been doing these updates to keep you guys posted on what's happening as well. Luis, unfortunately, you missed it out. You were out of town. That's fine. Come to the next one. Yeah. Those of you guys that didn't make it, we'll potentially have another one. So yes, sign up for it, okay? Now, let's look even further back in time to see where we are or where we have gotten. Let's take this back 5 years. And I know that this is a little complex to, wrap your head around, but 5 years ago, we weren't thinking about what was going to happen in 2025. We weren't thinking about who the president was going to be. We weren't thinking about tariffs. We weren't thinking about so many things that are happening, AI developing the way that it has so far. We were actually kind of still a little scared 5 years ago. We were coming out of the COVID year. And I know that that was a lot of uncertainty. And we did not see that COVID uncertainty hit the markets, but until 2022, as you guys can see here in the graph. In 2022 is where things shifted down. Market lost about 19% that year. All the indicators went down, including the bond market, as you guys can see. And this is something very interesting. And this is something that I wanted to point out, right? Those of you that had investments in bonds throughout that phase, throughout that period, you guys didn't hurt as much as those people that had equity in their investments, but you also didn't benefit from the growth that came after. As you guys can see, over the last 5 years, the S&P 500 has pretty much double in value, right? 100% growth. That's amazing. The NASDAQ has done about 121%. Dow Jones has been about 65, but the bond market is still a stagger since it went down. And it has to do with the interest rates. Interest rates needed to be increased in 2022 to battle inflation that skyrocketed. And we're going to talk a little bit about inflation later on today. But that was the reason why those bonds went down so much. And then for them to recover, it's taken several years. We haven't seen that come back yet. We hopefully, this rate cuts are going to do some benefit for those bonds, but it's going to still take some time. A lot of the times when people shelter their money in bonds, they believe that they're fully protected, but they are not. And it's important for you guys to be on top of what's happening with your portfolio and how much money should be there, how much money should be in equities. What other alternatives do we have, to hedge those situations, right? I know some people shelter their money on gold. Some people go to alternative investments to hedge the risk. Some people just park their money in cash. I've heard there's a lot of cash, or we've had a lot of cash over the last years because interest rates have been so big, so high, right? But that's about to change. So we'll talk about that in a second. At this point, I wanted to talk about the sector performance. What is the best performing sector in the stock market right now? And I asked this question to a client earlier today, and what they answer is obviously technology. And they were surprised to know that technology hasn't been the top performing sector year to date. The actual sector that has been outperforming the market and all other sectors has been the communication sector. That's interesting, right? Because we think that technology is the one that's leading the pack, especially because NVIDIA is the biggest stock out there and it's pulling the market up, and it keeps bringing new heights and it keeps growing. And so people might think that is overvalued. But communication sector has been the leading sector this year. Not only this year, but in the last year, it has also led the pack, followed by technology. And so it's important to look at what's happening in the market, what sectors are performing. Because when we see this picture, when we look at September 17 of 2025, and we see what sectors have been performing and which sectors have not been performing, some people feel a little bit more confident having money in investments such as healthcare, having money in investments such as the energy sector, or discretionary or materials or utilities. Those are some defensive sectors that have not been growing as much this year. And maybe you have been missing out on some gains, and maybe you have been even losing some, because of the allocation that you got on your portfolio. Okay, so it's extremely important. And that's where I like to bring the tactical management that we do. We do some tactical management because it's important to rotate those sectors. There are different cycles, and when we see different sectors performing in a better position, we want to move towards those so that we can thrive with those when the market is going up, and we want to stay away from those that are losing, right? Now, obviously, it depends on the time frame. It depends on the conditions. It depends on what asset class are we using. Any changes that are happening in the market conditions, we got to be on top of, and that's part of what we do here. So the reason why I wanted to bring this subject is because I was also comparing what have our portfolios done over the last year. And we happen to have two Guerra tactical portfolios that we manage. We have a stock portfolio and we have an ETF portfolio that we manage for our clients. We constantly make adjustments every 2 to 4 weeks. We are making changes on these portfolios. And some people always ask me, are these drastic changes? Miguel, are you guys like, buying and selling every day? No, we are managing a portfolio, and the management of a portfolio is not a day trade, okay, tactic. We are looking to optimize the portfolio by following those sectors that are performing best. And we actively manage those so that we don't fall behind of what's happening in the market, right? And if we can foresee some movement in the market, then we might shave off some sectors and move into other sectors that might present opportunities for growth, okay? We've been participating a lot. You guys might be wondering, why is this that high? But we have been participating in a lot of that technology sector and the communication sector over this past year, including the financial sector as well. So we got several stocks in those areas that are performing amazing. And maybe, it's time to start thinking, do we want to continue with the same trend? Is it going to continue the same way, or should we start capitalizing some gains, realizing some gains, and moving into other sectors? And that's important. That's a discussion that you should have with your advisor. If you don't have a plan, if you don't have a tactic, if you don't have a strategy for your portfolios, or for choosing your investments, if you're just following people because they're telling you to buy Palantir, buy NVIDIA, buy the new hot stock, then you don't have a strategy. You should be talking to an expert. You should be talking to a professional, okay? It's important to do that so that you can benefit from the growth and not lose your valuable dollars, okay? Your valuable money. Now, what is happening right now? What's the market sentiment and what are the risks today, right? So obviously there's optimism tied to the Fed rate cuts right now. We just heard that the Federal Reserve cut 25 basis points, which is supposed to propel the market up. And not only that, but the communication was that going forward, we should expect another 2 rate cuts, okay? And that allows more trade to happen, that allows more borrowing to happen, that allows more economical activity to happen, which in fact moves more money into equities, okay? There are some concerns about overvaluation, on some sectors, on some specific companies. And it's true, some companies have gone to new heights constantly over this past year. And it's important to review if you want to be exposed in those companies at all, or if you want to continue to have a portion and also diversify your money into other sectors and other asset risk classes, okay? And that's why you got to stay on top of what's happening, talk to your advisor, be in constant communication with them, all right? The market gains have concentrated on big tech names, and obviously we need to diversify ourselves, just not to fall in that trap, okay? Not to fall in that trap. Now, cash levels, we noticed that went lower, especially with federal rates being cut. It's going to translate into having less interest being earned on that cash money or those high yield savings or those money market accounts, because companies are eventually going to start dropping those rates as well. And therefore, institutional investors, even you as a retail investor, you're going to start feeling like your money is not earning enough, and you're going to potentially move into some other type of asset classes. And what we have identified that are, potential growing opportunity areas are those small cap companies, those maybe discretionary consumer, maybe international stocks or healthcare that are getting more attention now, and potentially will be a good play to start slowly transitioning some money into those, okay? Risk awareness is high, especially around inflation resurgence. the inflation report came back a little higher than expected. And if it overextends, then maybe that's a risk for the market, or that's a risk for the rate cuts that are potentially coming up. They might delay them, and that delays the market happening. So it's always good to pay attention to these details. Okay. Given the tax and insurance crisis in Dade, this is about Miami-Dade. Is the money moving? Is the real estate moving in Miami-Dade? We'll talk a little bit about that as well. Yeah, Raymond. Oh, Raymond is here. Raymond, thank you for listening in. Old client of ours. Yeah, send you love, Raymond. That's good. Very informative, a lot of useful and important information. Thank you, Andres. If you're not a client, reach out to us. So let's talk a little bit about inflation and where has inflation been, and why is this so important in regards to the interest rates. Okay. So if we go back and since we've been, looking back in time, let's do the same thing for inflation. If we go back to 2020, everything was a lot lower than, or a lot cheaper than what it is right now, right? And things just got extremely expensive by 2022. And the reason behind that growth on inflation, or that increase in inflation, better said, was the fact that there was a lot of influx of cash and also lack of inventory in different areas. Okay. If you guys recall, on the real estate market, there were a few houses being purchased by a ton of people, and there was a lot of cash flow, and there was a very low interest rate at that moment that would allow people to borrow more and to qualify for those loans. Therefore, prices started climbing up, and by 2022, we hit about a 9% inflation, which was extremely risky because it was giving us some flashbacks about the 1980s, where we experienced double digits on inflation. And so because of that happening, the Federal Reserve decided to start increasing interest rates drastically, okay, to contain that inflation. Now, they did that in 2022 and 2023, and then inflation went down to hit the fours and threes. And over the last year, it's been right under the 3%, okay? Now, this last month, inflation came up. The expectation was about a 2.7 year over year, and it came up at a 2.9. So we had an increase, which was causing some doubt on whether the Federal Reserve was going to cut or not, because they have been holding this argument about inflation potentially skyrocketing again, or not skyrocketing, but going back up because of the tariffs that we imposed back in April. So the argument from the Federal Reserve has been, because of these tariffs are increasing the cost of things and the cost of goods being imported or exported, right, imported from other places, then that cost is going to be transitioning to the consumer, and therefore things will cost more, and that inflation will continue to be there and be a little bit more extensive. So that's what has delayed the rate cuts. But if we pay attention truly over the last year or so, inflation has been contained. Yes, it has gone up, it has gone down, but it's still contained. And finally, today, the Federal Reserve decided it was about time to cut that 1/4 point. And it looks like they're going to be cutting another 2 times before the end of the year, according to the dot plot. We'll talk a little bit about that in a second. Another indicator for the economy is unemployment. Unemployment gives us a sense of what's happening in the job market, what's happening in terms of earnings, how much people have purchasing power because they're working, how much people don't have purchasing power because they're not working. So unemployment gauges that stuff and allows us to know, the level of activity, economic activity that we are having in the country. Now, I like to go and look back and see what happened back in 2008. And I know that all of you guys, I mean, those of you guys that are about my age, or, are not too young enough, and if you're thinking about retirement, you probably already went through this, then remember 2008. Remember the crash of the housing market. You remember the real estate crash and how that impacted the world and how it impacted the markets in every way. When that happened, the unemployment in the US rose to over 10%. Okay. And it was pretty high. It was pretty high. But then eventually we got it down, over the next decade. We got it down to almost about a 3% or so. But when COVID hit, we saw all these people being let go of the jobs because we had so much uncertainty that unemployment went all the way to 14%. So for a short period of time, the unemployment rate skyrocketed. Then when things started to come down 1 year later, we had brought that unemployment down to about a 3% or so. And then it's been going up ever since, right? Because that was the best moment. But it's been flirting with the 4 and 4.1, 4.2, and now 4.3% over the last year and a half. That's how unemployment has been. Now, the reason why that unemployment is important is because it's another factor that the Federal Reserve takes into consideration when they're cutting rates. If unemployment it's continues to decline, that means more people are working. That means there's more money moving around. That means inflation can come back up and creep back up on us, right? If unemployment rate is steady or it goes a little bit, higher than the regular, then that slows down the economy a little, and that allows the Federal Reserve to feel like they could cut. So this reading of the unemployment in August, which was a 4.3, and it was a little higher than the previous month, could have been one of those catalysts that had the Federal Reserve making that final decision today, because we've been waiting for that rate cut since last year, and it hasn't happened. Okay, but unemployment is one of those factors that is important, and it's important to take it into consideration as well when we're looking at the overview of the economy. Now, I know that some people might say, oh, but there's a lot of people losing jobs. There's a lot of people that are being let go, and so on and so forth. What we have seen is that some people that are leaving jobs are getting hired by other companies. Maybe they might not be making the same amount of money. Maybe they might not be in the same position. They might not be in the same industry as well, but they're being employed again. Okay, so that rate has been pretty steady over the last year, and we haven't seen that increase drastically. So that's a good factor. That's a good sign for the economy, guys. Okay, and then obviously let's talk a little bit about the rate cuts, because that's the big news today. Finally, after over a year of hearing we're going to cut rates, they decided to start cutting 25 basis points. So for those of you that don't know how interest rates work, the interest rates, when there are news about the interest rates, the Federal Reserve rates, those news have to do with the rates that the Federal Reserve uses to lend money to banks, or that's the rate that banks use to lend each other money. Okay, but those are not the rates in which banks lend us money or lend any business or any business owner money. Okay, because there's a huge discrepancy there, or it's not a mandate rate that banks need to use to pay you interest either. By the way, banks are private entities, and they guide themselves with these interest rates from the Federal Reserve, but that doesn't mean that they have to abide as a law how much they charge or how much they use on interest rates or how much they lend you based on those interest rates. Not at all. Okay, and I always like to clarify that because people have a discrepancy. Now, if we go and look at the history of interest rates from the Federal Reserve since the 2000s, we had interest rates at a 6%, a little higher than a 6% back in the 2000s. I don't know if you guys remember that, a decade from 2000 to 2008, but interest rates dropped drastically from 2000 to 2002, 2003, and then they started increasing from 2004 and all the way to 2008. And it had to do, it's interesting because when you look at the graph, you start thinking, oh my God, that is the time where the demand of real estate happened, right? And everything increased. So those interest rates, increased, and then we had the full crash and interest rates dropped drastically. Now, I like to see this graph essentially for a couple of things. It gives us a view of what's happened over time in history, but it also tells us that if you have kids, and most of you guys, if you're entering retirement, if you're in your late 50s, early 60s, potentially might have a kid or two that are in the current process of buying a property or, trying to get their first home. They have never seen these kids of yours, which potentially are my age or 10 years younger than me, have never seen interest rates go higher than a 4.5%. Because from the 2008 all the way until today, we have never seen the Federal Reserve with interest rates at a 5 or 5.5, 5.75 or 6%. We've never seen that until last 2 years, where most people have been complaining about the rates being so high. Now, I like to clarify that, once again, these rates are not the mortgage rates. These are the rates that the Federal Reserve uses as a guide for banks, okay? Now, when we go and look at what's happening with these interest rates and the implication of having those lower interest rates, then we can notice that obviously lower rates indicate more cash available for loans, right? We have lowering costs on borrowing. It boosts the stock market because usually people that have money in cash will start moving that money into equities and take advantage of the market growth, right? Also, credit and housing, this might mean cheaper loans. And I like this graph that I put right here because it illustrates the difference between the Federal Reserve funds effective rate and the 30-year fixed rate mortgage. They do have a relation, as you guys can see, but it's not 1-by-1. It's not 100% equal. It doesn't mean that when the market or when the Federal Reserve increases interest rates, those mortgage rates increase drastically, or when it drops it, those mortgage rates drop drastically. As a matter of fact, if you guys see the behavior from the end of 2024 until now, the Federal Reserve has dropped interest rates and the mortgage rates have still, stay steady. And the reason is because the banks price in those rate cuts if necessary, but since the Federal Reserve got stuck with the same rate, then they just kind of stay there through, around that same number, 6% to 7, 6.5, right? That's where those rates have been. Now, one of the reasons why the Federal Reserve didn't want to cut rates quickly is because they didn't want to accelerate the economical activity and increase more inflation, which is usually what happens when the Fed moves too quickly to cut rates, okay? But this is the highlight of today. The big thing was that they started finally cutting rates. And usually when the Federal Reserve moves in one direction, they remain moving in the same direction until they get to a stop. And then they switch the direction of things, okay? So what this means in essence is that the Federal Reserve potentially will just continue to cut rates as these factors allow the conditions for them to continue to cut. And most likely, we're going to see lower mortgage rates, lower borrowing money, and also lower interest rates on those cash accounts or those high yield accounts. And if that is the case, you have to start questioning yourself about what am I going to do with that money that I have sitting in that high yield savings account that is currently paying me 3.5, but potentially in a couple of months could be down to 2.9 or something like that, okay? And that's important, all right? It's extremely important. Peter, hey, Miguel, tell you you're diving deep into the market, worldwide economy. Good to see you. Thank you. Thank you. Always good to see that. Maria Urbana, remember? Yeah, awesome. If you guys have any comments, if you guys have any questions, please don't hesitate to send them to the chat. I got them here, and I'll be answering any questions that you guys may have. Now, what this does for the housing market, right? Or let's take a snapshot to August and the numbers on the housing market, because even though we don't do real estate is a big investment in the portfolio of our clients. Here in Miami, in Florida, most people love real estate, and they do have investments in real estate, and they are always constantly asking us, hey, what's happening with the stock market? What's happening with the real estate market? So I always like to bring this information up. Just a little snapshot from last month, right? Sellers, we had about 1,922,000, near the highest since March of 2020. So that means that we have a lot of people selling their properties right now, okay? But we don't have as much people buying properties, okay? We've had the lowest number since April of 2020 as well, okay? So that record gap of 508,000 more sellers than buyers, it's what makes you feel that the real estate market is right now kind of staggered, right? It's there. And we've seen, obviously, price cuts in some properties. I know that some of you guys are going to say, yeah, but Miami is just a different animal. Yeah, this is the general outlook of the US. I know that Miami is a different animal. We live in a different city, and everything has delayed a little bit more here, but we have seen some price changes in the Miami area as well. So that has gone down. Those higher mortgage have dropped the affordability on housing, and hopefully if this rate cuts come pretty quickly, then we're going to see some impact on those mortgages, and then we might see more activity on that housing market, okay? I always tell people, if you guys are looking to purchase a home, if it is an investment, make sure you do your numbers. If it is a house to live in and you found the right one and you can afford it, then yeah, make sure that you go and pull the trigger. It's always good to feel good about where you live and what you do, right? Bigger picture, cooling market may slow construction. We have more new developments coming in as well, and that creates more supply, right, for the amount of demand that we have. So hopefully we get to see some movement maybe by the beginning of next year or middle of next year. It's going to be a little bit more active, okay? Now, let's talk a little bit about the investments, because that is one of the buckets that our clients use, is real estate. But when we do the planning for our clients, we obviously take into consideration that real estate bucket, but we also take into consideration the 5 retirement planning buckets, okay? And if you don't know this concept, if you're not familiar with this concept, let me explain to you what this means, right? When we look at your retirement, we look at your retirement in different areas, and your money can do so many different things. And therefore you can, you've heard this saying that you shouldn't put all your eggs in the same basket, right? Because if that basket drops, then everything breaks. You should be able to diversify yourself. But the question is, how much money should go into each bucket, right? And the answer for every single person is different, right? Every single person has a different situation. Their family has a different situation. Some people need more liquidity than others. Some people, actually, some people that have a ton of real estate don't have any liquidity. We've run into families that might be worth several millions of dollars, and everything is in real estate, and their liquid accessible cash is not a lot. So it's important to make sure that you have some congruency on your planning, and that you have some congruency on the allocation of your investments, okay? Now, why is that also important? Because the market doesn't perform the same way that it has been performing over the last 12 months, always, or over the last 5 years, always. You know, there's some years that are negative, and if everything is in that risky growth bucket that you love, if you love the market, then at some point it's gonna hit you hard, okay? Process, performance, it's not going to be what if something happens. It's going to happen. It's going to happen at some point. There's always going to be a 2008. There's always going to be 2022. There's always going to be some tariff conversation. Something is going to pull the market down. And when that happens, if everything you got is in that risky bucket, it's no bueno either. So you got to make sure that you diversify your investments through these different buckets. We call it the cash bucket because it's the liquidity bucket. I know that it's currently at a 3 point something percent right now, but the average rate of return on that bucket on cash, on money markets, on CDs is an average between 0 and 3%, guys. That's what we've seen over time, because those interest rates are going to fluctuate. They're going to do exactly what I just showed you that they're going to do over time. They will move up and they will move down. And when they move down, that bucket is going to generate less money. Is it necessary to have money in that bucket? Yes, sometimes it is, because you need that liquidity. You need that quick access. Okay. Now, the question is how much? Well, it all depends. It depends on your plan. Now, there's also safe growth. For those, you can use fixed annuities, fixed index annuities. You could use the structured notes, medium or long-term bond funds, as you guys saw, that they're a little bit more steady, right? They still have some risk, but they're a little bit more steady. That generates about a 3 to 7% growth. In essence, it's kind of like a bucket where you can put your money in and feel that you're a little safer than earning a little bit more than the cash bucket, but a little safer than that risky growth bucket. And when the market downturns, you don't hurt that much. Okay. Now, risky growth is what we've been talking about right now, is what most of you guys care about, because you love to see that 12%, 13%, 14% return on those individual stocks or small caps or large caps. But the truth is, at some point, that is going to take a downturn. And when it does, how am I protected? Now, the last two buckets, those last two buckets, I always tell people, nobody ever thinks of these, but they're so important. They're so important because the fact is that 7 out of 10 people in retirement in their later years are going to need some sort of healthcare planning. They're going to need some sort of long-term care, or they're going to run into more higher health expenses. And that's where those HSAs, health savings accounts, come in handy. That's where those IULs with long-term care rider come in handy, or traditional long-term care policies come in handy, right? I had a conversation with a client the other day about them being self-insured because they have enough money. They're worth several $1 million. So if they run into a situation like this, they're protected. But we came to an agreement because what this person understood is I could position some money into this bucket and protect myself so that my family doesn't have to run out of money if I have a situation like this one, right? And then at that point is, how important is your family for you? I truly don't know. Can help you with that one, but there are some strategies to protect yourself in that sense. Okay. Now, most of you guys love your families. Most of us Hispanics, and I just, in essence, everybody that cares about their family wants to make sure that they leave a long-lasting legacy. And at that point, what's more important? What's the best tool to provide that a peace of mind for your family? Life insurance. Life insurance is a great tool to transition assets, especially because life insurance is tax-free. Not to talk to those of you that are above the threshold of the death tax, right? Or the inheritance tax. And I know that inheritance tax is pretty high right now, but keep in mind that if you guys own IRAs, 401ks, 403bs, 457s, FRS, pensions, or drops, TSPs, any of these qualified plans are fully taxable. And when anything happens to you and these assets are moved to your family, down to your kids or to your grandkids or whoever gets it, they are going to have to pay tax on this money. They got, their own income, they have their own life, and on top of that, now they're going to have to distribute money from these retirement accounts that you guys leave behind. And there's a great way to offset those taxes by creating a legacy plan for your family. So if you guys have not gone over these 5 buckets with your advisor, reach out to us, make sure you have the conversation, look into the different strategies, find out about an HSA or a long-term care policy, find out about how to maximize your legacy if that's what you want, tax-free. But we definitely want to encourage you to do that, okay? For those of you that are not familiar with our firm, I want to wrap it up showing you a little bit of our process and how do we work with our family. So we got a process, we call it the Guerra Freedom Plan. And the Guerra Freedom Plan, those of you that are clients, you essentially have gone through most of this, okay, if not everything. But those of you that are not, this is what it looks like. We have a phase one, it's a discovery, a phase where we find out a little bit about what's happening with you, what's going on with your family, what are your goals, your dreams. And then we do this custom freedom plan that I spoke to you guys about earlier, where we, find out what areas of opportunity you have. And then we move on to a consolidation phase with Fidelity, where we put everything at Fidelity, and then we start doing the hard work. We roll up the sleeves, we get the team working. Remember, we got about 70 people here at your disposal, and that's where the execution happens. So we go about the retirement planning, we find out how much money you need for living. We go in detail into those expenditures that you're going to have through retirement. And most people think that they're not going to have any expenses in retirement. I mean, I don't know in which world you guys live, but last time I checked, we live in Miami, and it's expensive to live here. Even to go have a cafecito on Calle Ocho it's very expensive when you go out with friends. So you got to keep that in mind. Identify that freedom number, which is the amount of money that you need for that retirement, and set up a withdrawal strategy. Look at your pension, maximize your Social Security, make sure that you're being as effective as possible in that retirement planning. And that also means optimizing your investments, using that 3-bucket strategy, cash, income, growth, how much money should be in each one of those, having that low fee and the low risk versus a high risk if necessary, depending on what's happening in your life. Ongoing rebalancing, which a lot of people don't do that constantly. We monitor our portfolios. We do that tactical management, which comes in very, very handy. Then there's taxes to look into, the 3 tax buckets, Roth conversions, RMD planning. I have a lot of clients right now requesting RMDs. And what's happening with those RMDs is you're paying taxes on it, and that might trigger IRMA surcharges. If you don't know the term IRMA surcharges, you need to come see one advisor, okay? Because some people are getting distributions from their accounts that are increasing their income and are costing you more money on the Medicare side. And that's important to see, okay? How can we offset those things? Tax loss harvesting, for those of you that have investments in the stock market, brokerage accounts, interest rate accounts generating, those you need to put in place. Long-term care planning, life insurance planning, auto insurance, all the corporate structure that is correctly. And then there's the estate and legacy planning. So we go about that phase. And then afterwards, we have an entire team dedicated to work with you guys, do the ongoing portfolio rebalancing, do the ongoing tax planning, and do the ongoing estate review planning as well, to make sure that, everything is working according to the plan. So if you have not met with us, if you are interested in meeting with us, reach out to us, click on the link. We can actually set up, somebody will reach out to you, set up an appointment, and one of our advisors, myself, Sebastian, somebody from the office is going to meet with you and go over this plan with you, okay? Like I said, first visit is to find out a little bit about you. Then we go into the Guerra Freedom Plan process and look into what's happening in every area, do the evaluation. This is a deliverable that you will actually physically get yourself so that you know where you're standing, right? On a scale from 0 to 10, or in this case, A to F, where you are at on every area. So we'll look into this. And your advisor, Eric. Luis is commenting on Eric Reynoso. That has been a great advisor, amazing guy. Yes, I love Eric. Eric is amazing, full of knowledge, Luis. Thank you for tuning in. But yeah, so a little bit about our team. and our leadership team, right? We got Mauro Guerra, Sebastian and Fabian, which you guys know are the leaders of our organization, and they're the visionaries of what we have envisioned to become the most reputable firm in South Florida for retirement planning, and help as many people, the biggest firm in South Florida and eventually the US, to help people retire comfortably. We have an advisory team. Someone already mentioned Eric Reynoso. Someone already mentioned Jimmy, Miguel, which you guys have met in the previous meetings. I know that you guys cannot miss Mark Bearfield. He moved from Texas here. Is the guy with the hat, the cowboy. Everyone loves him, very knowledgeable. And then we got Harvest and Mateo. Mateo has been with us a couple of years already, and he is our newest addition to the advisory team, doing an amazing job for our families and for the clients that we serve. If you guys are interested in booking something with us, here's a little QR code where you guys can actually go in and set up an appointment, get a phone call from the team, and set up something for yourself. I don't know if you guys have any questions, but I want to thank you for being here today, taking the time, listening to this update, and staying in touch with Guerra. It's always good to educate you guys and provide knowledge and make sure that you guys are staying the course in your plan. Make sure that you guys are doing what it's important to make sure that everything works, right? Anybody has any questions? I got next dinner and meeting with the staff of the county. We will be working on that, Liz. So Liz, I gotta talk to somebody from the team to reach out to you. If you reach out to us, then we can have that dinner set up for people that work for the county, for the state employees that have the FRS. Is a very in-depth pension plan that needs a lot of details when you are choosing and picking. So yes, I'll have somebody reach out. The QR code is partially hidden by the live monitor. Oh, I'm sorry, I apologize. Let me see if I can get it again to you guys. Is it better now? I don't know if you guys can see it, but there it is. Okay. But if you want, click on the link and you can actually set up a phone call. Somebody will call you and we can set up that event. Guys, I hope this was useful for you guys. I hope that this was what you were looking for today. And if you have any questions, don't hesitate to reach Guerra. Remember, make sure that you continue to plan and make sure that you stay the course on everything that you do, and you stay in touch with your advisors so that everything works. Okay, guys, have a good night.